There is a lie at the heart of modern finance, a pervasive, seductive, and dangerous lie. It's a lie whispered in business schools, shouted on financial news networks, and encoded into the spreadsheets that govern trillions of dollars of capital. The lie is that the numbers are the truth. It's the belief that if you can just master the language of income statements, balance sheets, and cash flow statements, you can understand a business. That a company can be reduced to a series of ratios and figures, and that mastery of these figures constitutes wisdom. But Warren Buffett, the most successful investor in history, built his fortune on a far more profound and unsettling truth. He knows that the balance sheet lies, not always with malice but through omission. It can tell you what has happened, but it cannot tell you what will happen. It can show you the symptoms, but it cannot reveal the cause. Because the single most important variable, the factor that will ultimately determine the long-term success or failure of any enterprise, will never appear as a line item. And that is the character, the rationality, and the mindset of the chief executive officer. This is not a lesson about finance, it is a lesson about judging human nature. It's for the serious investor, the driven entrepreneur, the executive trying to understand the landscape of corporate finance, who knows that surface-level analysis is a ticket to mediocrity. This is a deep dive into the real engine of value creation and destruction. We are going to deconstruct Buffett's method for reading the CEO, not the numbers. We will explore his concept of the institutional imperative, the invisible force that causes smart leaders to make foolish decisions. You will learn to spot the subtle warning signs in a leader's behavior, in their words, and in their decisions that signal danger long before it ever registers in the quarterly earnings report. This is the ultimate form of risk management, because while numbers can be managed, manipulated, and reframed, the fundamental character of a leader is the bedrock on which a fortune is either built or shattered. This is the final promise of value investing. Learn to read the person at the top, and you will understand the destiny of the company they lead. Our journey begins with the most insidious and powerful force in the corporate world, a concept Buffett himself coined and has battled his entire career. It's a psychological vortex that sucks in even the brightest minds, a gravitational pull towards mediocrity and ruin that is almost impossible to resist. He calls it the institutional imperative, and understanding it is the first and most critical step in learning to see a business through Buffett's eyes. It is the lemming-like tendency of CEOs, regardless of their individual brilliance, to mindlessly imitate the behavior of their peers. It doesn't matter if the behavior is self-destructive, irrational, or demonstrably stupid. The desire to conform, to not stick out, to do what everyone else is doing, overrides logic and sound business judgment. This imperative is the unseen ghost in the corporate machine, responsible for more value destruction than any recession or market crash. And for Warren Buffett, the most painful and expensive lesson he ever received on this topic came not from a company he analyzed, but from one he himself bought. The story is a brutal case study in investment advice and a monument to a billion-dollar mistake. The company was Dexter Shoe. The year was 1993. Berkshire Hathaway was flying high. Buffett was already a legend, a financial icon whose annual letters were treated as scripture by the value investing community. He was looking for large acquisitions, what he calls elephants, to deploy Berkshire's growing mountain of cash. And he found what he thought was the perfect target. Dexter Shoe, based in Maine, was an American manufacturing success story. It was a profitable, well-managed company with a long history of success. Its leader, Harold Alfond, was exactly the kind of manager Buffett loved, a brilliant operator who had built the business from the ground up and managed it with a fanatical devotion to quality and efficiency. Buffett fell in love with the business and, more importantly, with its manager. He saw a durable competitive advantage, a strong brand in American-made footwear, and a leader he could trust implicitly. The deal was struck. But here is where the story turns. Instead of paying cash, Buffett made a fateful decision. He decided to pay for Dexter Shoe with Berkshire Hathaway stock. The price was $203 shares of Berkshire A, which at the time were valued at approximately $433 million. To use Berkshire stock as acquisition currency was, for Buffett, the ultimate sign of respect. It was like an artist paying for a house with one of his own masterpieces. It meant he wasn't just buying Dexter, he was making Harold Alfond and his team partners in the entire Berkshire enterprise. On the surface, everything looked perfect. A great American business, a stellar manager, and a deal that made everyone a partner. But there was a fatal flaw, a flaw that had nothing to do with the numbers on Dexter's financial statements and everything to do with forces far beyond its control. What Buffett and his partner Charlie Munger had failed to fully appreciate was the relentless, unstoppable tide of foreign competition. Low-cost manufacturers from overseas were beginning to decimate the American footwear industry. Dexter's competitive advantage, its moat, which had looked so wide and deep, was evaporating. It turned out that the company's past profitability was not an indicator of its future prospects. The economics of the industry had fundamentally and permanently changed. The business was doomed. Over the next few years, Berkshire poured more money into Dexter, trying to shore it up, but it was like trying to fill a bathtub with the drain wide open. The company's value collapsed. Eventually, the business was worthless. The $433 million of Berkshire Hathaway stock used to buy it was gone. But the true cost was far, far greater. Those 203 shares of Berkshire stock, if they had never been traded for Dexter shoe, would have grown in value alongside the rest of the company. Today, the value of that stock would not be $433 million. It would be well over $12 billion. It stands as one of the largest financial blunders in modern history, by Buffett's own admission. In his 2007 annual letter, he wrote with his trademark candor, "To date, Dexter is the worst deal that I've made. But I'll make more mistakes in the future. You can bet on that. As a financial disaster, this one deserves a spot in the Guinness Book of World Records." So where does the institutional imperative fit into this tragic business analysis? The pressure Buffett felt was the imperative to act. He had a growing pile of cash, and the institutional expectation for a CEO in his position is to deploy that cash, to make acquisitions, to grow the empire. Sitting on cash is often viewed as passive and uncreative. The imperative pushes a leader to do something. Furthermore, the prevailing wisdom of the time might have suggested that American manufacturing was a solid, dependable industry. Buying a company like Dexter was a conventional, understandable move. Buffett, the ultimate rationalist, fell victim to the same forces he so often warns against. He saw a great manager and a record of good numbers, and allowed that to blind him to the crumbling foundation of the business itself. The lesson wasn't that Harold Alfond was a bad manager, he was a brilliant one. The lesson was that a brilliant manager in a business with terrible economics is fighting a battle they cannot win. And the institutional pressure to make a deal, to be an active CEO, can cause even the Oracle of Omaha to misjudge the economic battlefield. This multi-billion-dollar mistake became a core part of the Berkshire Hathaway curriculum, a permanent reminder that the most dangerous force in business isn't a bad balance sheet, but the silent, collective madness of the crowd. The machinery of the institutional imperative is not driven by faulty spreadsheets or poor corporate finance models. It is powered by the ancient, hardwired circuitry of the human brain. The specific psychological principle at play is one of the most powerful forces in human behavior, social proof, often demonstrated through the lens of herd mentality. This isn't just a quirk of amateur investors. It is a profound cognitive bias that affects even the most powerful leaders and is a cornerstone of any deep stock market analysis. The classic illustration of this phenomenon comes from the Asch conformity experiments conducted in the 1950s by psychologist Solomon Asch. The setup was simple. A subject was placed in a room with a group of actors, all of whom had been instructed to give a specific, incorrect answer to a simple question. The group was shown a line on a card, and then asked to pick the line of a matching length from a set of 3 other lines on another card. The answer was glaringly obvious. Yet, one by one, the actors would confidently state the wrong answer. By the time it was the subject's turn to answer, they were faced with a dilemma: trust their own eyes, or trust the unanimous judgment of the group. The results were staggering. A huge percentage of subjects buckled under the pressure. They knowingly gave the wrong answer, choosing to conform with the group rather than state the obvious truth. Their own senses were telling them one thing, but the social pressure to not be the odd one out was so immense that it overrode their own perception of reality. Now transpose this experiment from a psychology lab to a corporate boardroom. The CEO is the subject. The board members, the industry analysts, the financial journalists, and the CEOs of competing companies are the actors. The question is no longer about the length of a line. It's about corporate strategy. For example, in the late 1990s, the obvious answer being shouted by everyone was, "You need an internet strategy." The herd was moving in one direction. A CEO of a traditional brick-and-mortar company would look at their competitors buying up .com startups for astronomical prices. They would read in the Wall Street Journal that companies without a .com in their name were dinosaurs. Their investment bankers would be pitching them on expensive, flashy tech acquisitions. The social proof was overwhelming. Even if their own rational analysis told them that paying 100 times revenue for a company with no profits was insane, the pressure to conform was immense. To stand up in that environment and say, "No, we're not going to do that, it doesn't make any sense," was the equivalent of the subject in the Ash experiment shouting out the correct answer while everyone else stared at them. It invited ridicule, criticism, and accusations of being out of touch. The safe, comfortable, and socially acceptable path was to join the herd. And so, they did. They overpaid for acquisitions, they launched ill-conceived online ventures, and they destroyed billions in shareholder value. They weren't stupid, they were just human. The CEO mindset is not immune to the fundamental wiring of the human brain. The institutional imperative is social proof scaled up to the level of corporate strategy. It manifests in various ways: a mindless rush into diversification, an obsession with acquisitions at any price, a compensation structure that mimics competitors rather than one that drives performance, or the expansion of bureaucracy simply because that's what large companies are supposed to do. A CEO sees their rivals building a lavish new corporate headquarters, and suddenly they feel the need to build one too, regardless of the cost or utility. It's keeping up with the Joneses on a billion-dollar scale. Buffett's genius is not just in his financial acumen, but in his psychological fortitude. He has cultivated the ability to be the lone subject in the Ash experiment, who calmly and confidently states the obvious truth, indifferent to the unanimous, but incorrect, judgment of the crowd. This emotional and psychological discipline is the bedrock of his approach to wealth management and a critical skill for entrepreneurs who want to build lasting value rather than follow fleeting trends. So how can we, as investors, entrepreneurs, or executives, immunize ourselves against this powerful psychological force? How can we develop the clarity to resist the pull of the herd? The answer lies in adopting a practical mental model, a systematic approach to decision-making that forces independent thought. Warren Buffett's methodology for this is heavily influenced by another investing legend, Philip Fisher, and his scuttlebutt method. It's a blueprint for actively seeking out information that contradicts the prevailing narrative. We can adapt this into a modern framework, a step-by-step process for spotting and resisting the institutional imperative. Step 1 is to identify the prevailing industry narrative. Before you even look at a specific company, you must understand the story that the entire industry is telling itself. Read the major industry trade publications, listen to earnings calls from the top 5 companies in the sector, and see what the high-paid Wall Street analysts are writing about. What is the hot topic? Is it artificial intelligence integration? Is it a massive wave of mergers and acquisitions? Is it expanding into China? Your goal is to define the lemming cliff for that particular industry at that particular time. Every industry has one. You must know what it looks like before you can tell if a CEO is running towards it. Step 2 is to conduct a forensic audit of the CEO's language. Get the last 5 annual shareholder letters from the company you are analyzing. Read them not for the numbers, but for the words. Is the CEO's language a carbon copy of the industry jargon you just identified? Are they using all the same buzzwords? Or does their writing display a unique, independent, and business-focused perspective? A CEO who is thinking for themselves will sound different from the herd. Buffett's letters are a masterclass in this. While other CEOs in the 1980s were talking about synergistic acquisitions and leveraged buyouts, Buffett was talking about economic moats and intrinsic value. He was using his own language, based on his own mental models, not the fashionable dialect of Wall Street. A CEO who parrots the industry consensus is a CEO who is likely following it right off the cliff. Step 3 is a direct comparison of actions. Make a simple list. In one column, list the major strategic moves made by the company's top 3 competitors in the last 3 years. In the other column, list the major strategic moves made by the company you are analyzing. Are they eerily similar? Did competitor A make a large acquisition in Europe, only to be followed by your company making a similar acquisition 6 months later? This is a massive red flag. Rational business strategy is specific to a company's unique position and advantages. Mindless imitation is the hallmark of the institutional imperative. A truly great leader forges their own path. They don't just follow the footprints of others. Step 4 is to apply the inaction test. This is a powerful thought experiment. Look at the company's most recent major decision: a big acquisition, a massive share buyback, a huge capital expenditure project. Now ask yourself this critical question. If the CEO were given this pile of cash and told there was absolutely zero pressure to do anything with it for the next 5 years, would this still be the single best, most rational use of that capital? Often the answer is a resounding no. The acquisition was made because the company was under pressure to show growth. The buyback was done to prop up the stock price in the short term. The new factory was built to match a competitor's expansion. The inaction test helps you separate decisions driven by sound, long-term business logic from those driven by institutional pressure. Finally, step 5 is to seek out the contrarian view. Find the one analyst, the one blogger, the one curmudgeonly fund manager who is saying that the prevailing industry narrative is wrong. You may not agree with them, but you must understand their argument. The institutional imperative thrives in an echo chamber. By actively seeking out and engaging with dissenting opinions, you shatter that chamber and force yourself to defend your own position with logic, not just by pointing to what everyone else is doing. This entire process is about building a defense mechanism against social proof. It's a framework for disciplined, independent thought, the essential prerequisite for successful long-term investment advice and executive decision-making. To truly grasp the destructive power of the institutional imperative, we must examine its opposite. We must walk the path of the 99%, the road paved with common sense that leads directly to financial ruin. This is the path of chasing hype, of mistaking popular opinion for sound judgment. And there is no greater example in modern history of this collective insanity than the dot-com bubble of the late 1990s. It was a period when the institutional imperative was injected with steroids, creating a mania that consumed the entire corporate world. The prevailing narrative was intoxicatingly simple. The internet was changing everything, and any business not fully embracing this new paradigm was destined for the ash heap of history. This wasn't just a story told among tech startups in Silicon Valley. It became a dogmatic belief in the boardrooms of the oldest, most established companies in America. The pressure was immense. If a CEO from a so-called old economy company stood before shareholders and didn't have a multi-billion-dollar internet strategy, they were treated as a fool, a relic. The stock price would suffer, and their job would be at risk. The result was a corporate cargo cult. CEOs who a few years prior were experts in manufacturing widgets or selling insurance suddenly felt compelled to become tech visionaries overnight. They saw their stock multiples languishing in the teens while any company with .com in its name was trading at 50 or 100 times revenue, or even more absurdly, at multiples of website clicks. The institutional imperative screamed, "You must do something. You must be a part of this." And so they acted, with disastrous consequences. Companies that had no business being in the tech space began a frantic scramble for relevance. They started acquiring dot-com startups with no revenue and no profits, paying prices that were ludicrous even by the insane standards of the day. A classic example is the traditional brick-and-mortar retailer that would spend hundreds of millions of dollars to buy a flashy but unprofitable e-commerce website, hoping to staple a high-tech growth story onto their slow-moving, old-world business. The market would cheer the move, the stock would pop for a few weeks, and the CEO would be hailed as a forward-thinking genius. But the underlying business logic was non-existent. They were simply following the herd. This mania extended even to changing corporate identities. Dozens of established companies, in a desperate bid to catch the dot-com updraft, literally changed their names to sound more tech-savvy. A company that made, for example, office supplies might rebrand itself as OfficeNet Solutions, Inc. The stock would often surge on the news, even though absolutely nothing about the underlying business had changed. It was a pure triumph of perception over reality, driven entirely by the imperative to conform to the new narrative. While this madness was unfolding, Warren Buffett and Berkshire Hathaway became objects of widespread ridicule. Buffett, with his steadfast focus on profitable businesses with long-term competitive advantages, was openly mocked as a dinosaur. He didn't get the new economy. Berkshire Hathaway, which held no significant tech stocks, dramatically underperformed the soaring NASDAQ index. Magazine covers famously asked, "What's wrong, Warren?" He was the subject in the Ash experiment, calmly pointing to the obviously correct line, while the rest of the world screamed that the wrong line was the right one. His refusal to participate was not born of ignorance, but of discipline. He knew he was operating outside of his circle of competence, and more importantly, he recognized the mania for what it was, the institutional imperative in its most virulent form. He saw CEOs he knew were smart, making decisions they knew were irrational, simply because they could not bear the psychological pain of being left behind. When the bubble inevitably burst in 2000 and 2001, the consequences were catastrophic. The companies that had chased the hype saw their stock prices collapse. The overpriced dot-com acquisitions were written down to zero. The foolish name changes were quietly reversed. Billions, if not trillions of dollars of shareholder wealth were vaporized. And Warren Buffett, the dinosaur, was revealed to have been the Noah of the investment world, having safely kept his shareholders' capital in an ark of rationality while the flood of irrationality washed everyone else away. The path of the 99% is always the easiest to follow. It requires no independent thought, no courage, and no risk of looking foolish in the short term. But as the dot-com bubble proved, it is often a path that leads directly off a cliff. The damage caused by the institutional imperative isn't just theoretical or anecdotal. It leaves a clear, quantifiable scar on the financial statements of a company. There is a direct financial connection between a CEO following the herd and the destruction of shareholder value, and its name is goodwill. Understanding this connection is a critical piece of advanced financial statement analysis. When one company acquires another, the purchase price is often higher than the fair market value of the assets being acquired. This makes sense. You pay a premium for things like brand name, customer relationships, and future growth prospects. In the world of accounting, this premium, the amount paid over and above the tangible value of the assets, is recorded on the acquirer's balance sheet as an asset called goodwill. In a rational world, goodwill represents the future economic benefits the company expects to receive from the acquisition. But in a world governed by the institutional imperative, goodwill often represents something else entirely. It is the fossilized remainder of a CEO's ego and poor judgment. Let's revisit our dot-com bubble example. Imagine a staid, old-economy manufacturing company, Oldco, feeling the pressure to get into the internet game. They identify a hot, new startup, Newcom.com. Newcom has no profits, minimal revenue, and its only real assets are a handful of computers and some clever software code. But it has buzz. The market loves it. The CEO of Oldco, driven by the imperative to have a tech story, decides to buy Newcom for $500 million. Let's say the fair value of Newcom's computers and other tangible assets is only $1 million. On the day the deal closes, Oldco's balance sheet will suddenly show a new asset, $499 million in goodwill. This number is, in essence, a monument to the premium paid for hype. It's the financial embodiment of the CEO's decision to follow the herd. Now, for a time, everything seems fine. The goodwill sits on the balance sheet, an impressive-looking number that makes the company's total assets seem larger. But accounting rules require companies to periodically test their goodwill for impairment. This means they have to assess whether the acquisitions they made are actually generating the returns they expected. In the case of Newcom, the answer is almost certainly no. The promised synergies never materialize, the growth stalls, and it becomes clear that Oldco massively overpaid. When this reality can no longer be denied, the company is forced to take a, quote, goodwill impairment charge. They must publicly admit that the goodwill on their balance sheet is not worth what they thought it was and write it down. This impairment charge flows through the income statement as a massive loss. The $499 million of goodwill might be written down to zero, resulting in a nearly $500 million reported loss for the quarter. This is not just an accounting entry. It is a direct public confession that the capital allocated to that acquisition was destroyed. The money is gone forever. For an investor or entrepreneur learning how to pick stocks or analyze a business, a history of large goodwill impairments is one of the most significant red flags you can find. It is the financial scar tissue left behind by a management team that succumbed to the institutional imperative. When you see a company's balance sheet with a goodwill figure that is a very large percentage of its total assets, you must be skeptical. It suggests the company's growth has come primarily through acquisitions, not organic success. You must then dig deeper. Have they had to write down goodwill from past deals? Are the acquisitions in fields far outside their core business, suggesting a diversification strategy? Bloating goodwill, followed by subsequent impairments, is the clearest possible sign of a leadership that prioritizes chasing trends over the disciplined, rational allocation of capital. It's the smoking gun that tells you the CEO is playing a different game, a game of empire building and hype, not a game of long-term value creation. If the institutional imperative is the disease, then the cure is a ruthless, disciplined, and logical approach to the single most important job of any CEO: capital allocation. This is the second great pillar of Buffett's management evaluation. At its core, a business generates cash. The CEO's job is to take that cash and deploy it in a way that creates even more cash in the future for the shareholders. It sounds simple, but it is the arena where true managerial greatness is separated from mediocrity. A CEO has only 5 things they can do with the company's earnings. They can reinvest it back into the existing business. They can acquire other businesses. They can pay down debt. They can buy back the company's own stock, or they can pay it out to shareholders as a dividend. That's it. There are no other options. A CEO's entire legacy and the long-term fate of the shareholders' investment rests on how intelligently they make these choices over time. For Buffett, the gold standard, the platonic ideal of a master capital allocator, was a man named Tom Murphy, the CEO of Capital Cities, ABC. The story of Tom Murphy and Capital Cities is a legend in the annals of value investing and a masterclass in executive decision-making. Murphy, along with his partner Dan Burke, took control of a small, struggling television station in Albany, New York in the 1950s. Over the next 4 decades, through a series of shrewd, disciplined, and perfectly timed decisions, they built it into a media juggernaut that would eventually encompass the entire ABC network. What made Murphy a hero to Buffett was his absolute, fanatical devotion to rationality and shareholder returns. He was the antithesis of the empire-building CEO. He ran his businesses with a skeleton crew, despising the bureaucracy and bloat that was common at other media companies. Stories of his frugality are famous. While competitors were building lavish corporate headquarters, Capital Cities was run out of a nondescript office with Spartan furnishings. They didn't own a corporate jet. Murphy believed that every dollar spent on unnecessary overhead was a dollar stolen from the shareholders. But his true genius was in capital allocation. When his businesses generated cash, he and Burke would ask a simple question: where can we deploy this dollar to get the highest possible return? For many years, the answer was buying more television and radio stations. They were disciplined buyers, waiting patiently for opportunities to purchase good assets at reasonable prices, often from less disciplined competitors. They never overpaid. If no attractive acquisitions were available, they were perfectly content to let the cash build up or pay down debt. They were masters of patience, a rare virtue in the corporate world. Their crowning achievement came in 1985. Capital Cities, by then a large and successful but still lean company, did the unthinkable. They launched a bid to acquire ABC, a company nearly 3 times their size. It was a David and Goliath story. Wall Street was stunned. But Murphy had done his homework. He saw that ABC, while a great brand, was run inefficiently, with a bloated cost structure. He knew that by applying his lean, decentralized management style, he could dramatically increase its profitability. He lined up the financing, including a significant investment from his admirer Warren Buffett, and pulled off one of the largest media mergers in history. After the merger, Murphy did exactly what he said he would do. He ruthlessly cut costs, empowered local managers, and focused the business on what it did best. The profitability of the combined company soared. For the next decade, he continued to run the business with the same rational, shareholder-focused discipline. Finally, in 1995, seeing the media landscape changing and believing the company had reached its peak value, he made his final, brilliant capital allocation decision. He sold the entire company, Capital Cities ABC, to the Walt Disney Company for $19 billion. Over his tenure, a single dollar invested with Tom Murphy would have grown to over $2,000. It was a record of wealth creation that is almost unparalleled in American business. Buffett has said of Murphy, "He is the best business manager I've ever met." The reason is that Tom Murphy understood that his job was not to be famous, not to build the biggest empire, and not to grace the covers of magazines. His job was simply to take the capital entrusted to him by his shareholders and turn it into more capital. Every decision he made was viewed through that simple, powerful lens. His story serves as the ultimate benchmark against which all other CEOs should be measured. The reason so many CEOs fail at capital allocation, the very task that defines their job, can be traced back to a pair of powerful psychological biases that warp rational decision-making. The first is the endowment effect, and the second is the sunk cost fallacy. These two cognitive traps work in tandem to transform a CEO from a rational steward of shareholder capital into an emotional defender of a failing empire. The endowment effect is our tendency to overvalue something simply because we own it. A simple experiment demonstrates this perfectly. If you give a person a coffee mug and then offer to buy it back from them, they will typically demand a price that is significantly higher than the price they themselves would have been willing to pay for the mug just moments before. The mere act of ownership imbues the object with a subjective, emotional value that has no basis in its objective worth. For a CEO, the coffee mugs are the company's various divisions and business units. A division that they themselves helped build or acquire is not just an asset on a balance sheet, it's asterisk their division. It's endowed with their ego, their history, and their reputation. This emotional attachment makes it incredibly difficult for them to make a rational decision to sell it, even when it's clearly underperforming and dragging down the entire company. A truly rational capital allocator like Tom Murphy or Warren Buffett is emotionally detached. They view business units as just assets, pieces on a chessboard, to be bought or sold based purely on their ability to generate cash returns for the owners. They have no endowment effect. Working alongside this is the even more insidious sunk cost fallacy. This is our irrational tendency to continue with a failing course of action, because we have already invested significant resources, time, money, or effort into it. We've all experienced this. We sit through a terrible movie because we've already paid for the ticket. We continue to pour money into a car that constantly breaks down because we've already put so much into it. The rational decision in both cases is to cut our losses. The money is already spent. It is sunk. The only thing that should matter is the future cost and benefit. But our brains are wired to hate the feeling of admitting a past decision was a mistake. We feel that if we just invest a little more, we can turn it around and justify our original choice. In the corporate world, this fallacy is responsible for breathtaking levels of value destruction. A CEO launches a major new product line. It requires $1 billion of investment in a new factory. 2 years later, it's clear the product is a flop. It's not selling, and it's losing money every quarter. The rational decision is to shut it down, sell the factory for whatever it's worth, and redeploy that capital into a more promising venture. But the sunk cost fallacy takes hold. The CEO thinks, "We've already spent $1 billion on this, we can't just give up now." So they authorize another $200 million for a new marketing campaign. When that fails, they invest another $100 million in retooling the product. They are throwing good money after bad, not because of a sound business case, but because they cannot emotionally accept the initial $1 billion investment was a mistake. A great CEO, in contrast, is a master of cutting their losses. Buffett himself demonstrated this, albeit painfully, with the Berkshire Hathaway textile mills. He kept them running for years, investing more capital, hoping to turn them around. It was a classic sunk cost trap. His eventual decision to shut them down, admit the mistake, and move on was one of the most important and value-creating decisions of his career. He learned to ignore the past and focus only on the future, a psychological discipline that separates the elite capital allocator from the average manager. To translate this theory into a practical tool, we can create a clear, actionable mental model, the 5-option capital allocation checklist. This is the blueprint that investors and entrepreneurs can use to judge a CEO's decisions, and that executives can use to guide their own. It forces a rational, hierarchical approach to deploying corporate cash. When a company generates $1 of profit, the CEO must run it through this 5-part gauntlet, in order. The first and best option is always to reinvest that dollar back into the core business. But this comes with a giant, non-negotiable condition. The business must be able to generate high rates of return on that incremental capital. If you run a great business like See's Candies, which earns fantastic returns, opening a new store with that dollar of profit is a brilliant decision. But if you run a business in a highly competitive, low-margin industry, like the textile mills Buffett owned, reinvesting that dollar back into new looms is like using it for kindling. It will be burned up by poor economics. So the first question for a CEO is, can I reinvest this dollar in my core operations and earn a return that is significantly higher than my cost of capital? If the answer is a clear yes, the analysis stops here. This is the holy grail of value creation. If the answer is no, we move to option 2, acquiring another business. This is a tempting but treacherous path. A good acquisition can create enormous value. A bad one can destroy it. The criteria here are strict. The acquisition must be in a business the CEO understands. Within their circle of competence, it must have favorable long-term economics, and it must be purchased at a sensible price. The vast majority of corporate acquisitions fail on one or more of these fronts, often because the CEO is driven by ego or the institutional imperative, rather than a sober calculation of value. If no high-return internal projects are available and no sensible acquisitions can be found, the CEO proceeds to option 3, paying down debt. This is the most underrated and prudent use of capital. Reducing debt strengthens the balance sheet, reduces interest expense, which boosts future earnings, and provides a cushion against future downturns. It is a conservative, risk-reducing move that is often scorned in bull markets when leverage is fashionable, but it is a decision that creates immense long-term resilience. Good CEOs respect the power of a fortress balance sheet. If the business has no high-return reinvestment opportunities, can't find any smart acquisitions, and already has a conservative amount of debt, we arrive at option 4, buying back the company's own stock. This is one of the most misunderstood actions in corporate finance. A share buyback can be either brilliantly value creative or utterly idiotic. The only thing that determines which is the price at which the shares are repurchased. If the company's stock is trading in the market for a price that is asterisk below the CEO's conservative estimate of its intrinsic value, then buying back shares is a fantastic use of capital. It's like buying a dollar bill for 80 cents. Every share repurchased increases the remaining shareholders' ownership stake in the business for a bargain price. However, if the stock is trading asterisk at or above its intrinsic value, then buybacks destroy value. The CEO is using shareholder cash to overpay for their own shares. Many CEOs buy back stock at the top of the market to prop up the stock price, a clear sign they are focused on short-term perception, not long-term value. Finally, if and only if all 4 previous options are exhausted, we reach the 5th and final option, paying a dividend. If the company is generating more cash than it can intelligently deploy through any of the other 4 methods, then the only rational and honest thing to do is to return that cash to its rightful owners, the shareholders, so they can reinvest it themselves. A dividend is a quiet admission by management that they have run out of high-return ideas. This 5-step checklist provides a logical framework for any capital allocation decision. As an investor, when you see a CEO make a major move, run it through this model. Are they following the logic, or are they skipping steps, driven by ego or hype? The answer will tell you almost everything you need to know about their quality as a manager. The opposite of this disciplined approach, the path of the 99%, has a specific name: diversification. The term was coined by the legendary fund manager Peter Lynch to describe the tendency of companies to expand into businesses they don't understand, ultimately creating a conglomerate that is worth less than the sum of its parts. It is the most common and most destructive failure of capital allocation. The story typically begins with a company that has a single, highly successful core business. It's a cash cow, generating more money than it can sensibly reinvest. The CEO, having saturated the core market, is faced with the capital allocation checklist. But instead of returning the money to shareholders via dividends or buybacks, their ego and the institutional imperative take over. They want to keep growing. They want a bigger empire. So they embark on a quest for acquisitions in completely unrelated fields. The logic they sell to the board and to Wall Street is that their brilliant management skill is transferable to any industry. A company that makes breakfast cereal, for example, might decide to buy a toy company. Then, flush with cash from those 2 businesses, it might buy a chain of restaurants. Then, a shoe company. On paper, the company is getting bigger and bigger. Revenues are climbing. The CEO is celebrated as a visionary empire builder. But beneath the surface, a cancer is growing. The management team at headquarters, whose expertise was in the cereal business, has no idea how to run a toy company or a restaurant chain. They can't add any value. They impose a layer of corporate bureaucracy on what were once nimble, independent businesses. The original entrepreneurs who built the acquired companies often leave in frustration. The result is a messy, unfocused collection of mediocre businesses, each of which would likely be more successful on its own. The promised synergies never appear. In fact, the conglomerate structure creates anti-synergies, where the whole is actively worse than the parts. A classic historical example of this was the conglomerate craze of the 1960s and 70s. Companies like ITT, which started as a telecommunications company, famously bought everything from Avis Rent-A-Car and Sheraton Hotels to a company that made Hostess Twinkies. The company became so complex and sprawling that no one, including its own management, could fully understand it. The performance of these conglomerates eventually faltered, and the market recognized the folly of diversification. Many of these giants were eventually broken up in the 1980s and 90s, with their individual business units often thriving once they were freed from the suffocating embrace of the corporate parent. This cycle of mindless expansion and painful contraction is a direct result of CEOs failing the capital allocation test. They choose the worst option, acquisition, and apply it to the wrong targets for the wrong reasons. They are driven by a desire for growth for its own sake, which benefits their own pay and prestige but almost always harms the long-term shareholder. When you see a company making acquisitions far outside its circle of competence, you are likely witnessing the early stages of diversification, a clear signal to be wary of the management's judgment. The ultimate report card for a CEO's capital allocation skill is not the stock price or the size of the company's revenue. It is a single powerful metric that cuts through the noise and reveals the truth: return on invested capital, or ROIC. This number is the direct financial connection, the undeniable proof of a management team's ability to turn $1 of shareholder money into more than $1 of business value. Understanding ROIC is fundamental to any serious business analysis. In simple terms, ROIC measures how much profit a company generates for every dollar of capital that has been invested in it. The capital invested includes both the money shareholders have put in, equity, and the money lenders have put in, debt. The return is the company's net operating profit after taxes. So, if a company has $100 million of capital invested in its operations, and it generates $20 million in operating profit in a year, its ROIC is 20%. This means for every dollar of capital tied up in the business, the management team was able to generate 20 cents of profit. A high and sustainable ROIC is the financial fingerprint of a great business run by great management. It tells you two things. First, it tells you the business itself has a strong competitive advantage, or a moat. Companies in highly competitive, commodity-like industries will struggle to earn high returns on capital. There are too many rivals driving down prices and eroding profits. But a company with a strong brand, a patent, or a low-cost advantage can price its products well above its costs and generate handsome returns. Second, and just as importantly, a high ROIC tells you that the CEO is a masterful capital allocator. They are consistently taking the profits from the business and reinvesting them in projects that also earn high returns. A bad capital allocator can destroy even a great business. Imagine a company that earns a 25% return on capital, but then the CEO takes all the profits and invests them in a foolish diversification acquisition that only earns a 5% return. Over time, this will drag the company's overall ROIC down towards that lower number, destroying value in the process. Conversely, a great capital allocator like Tom Murphy can take a decent business and, through disciplined reinvestment and smart acquisitions, dramatically increase its ROIC over time. The trend of ROIC is therefore even more important than the absolute number. Is the company's ROIC consistently high and stable, or even better, rising over time? This is the sign of a healthy, growing, and well-managed enterprise. Or is the ROIC low, volatile, or declining? This is a massive red flag that suggests either the business's competitive position is eroding or that management is making poor investment decisions. For investors and entrepreneurs, you don't need to be an accountant to use this tool. Financial websites like Morningstar or Yahoo Finance often calculate and display ROIC for you. Your job is to look at the 10-year history of this number for any company you are analyzing. Is it consistently above 15%? That's a sign of a potential high-quality business. Is it consistently below 10% or all over the place? That's a sign of a mediocre business or poor management. ROIC is the ultimate quantitative truth. A CEO can use fancy words in an annual report, but they cannot hide from this number. It is the acid test of their performance, revealing with brutal clarity whether their decisions are creating value or destroying it. We now arrive at the third pillar of Buffett's evaluation process, a tool so simple yet so powerful that most investors overlook it entirely. It requires no complex financial modeling, just a quiet room and a critical mind. It is the art of reading the company's annual letter to shareholders. Buffett famously says he gets more insights from reading these letters and the accompanying annual reports than from any other source. But he is not just reading for numbers, he is reading for character. He believes that a CEO's writing style, their tone, their clarity, their honesty, is a direct reflection of their management style. The annual letter is a window into the CEO's mind, and by learning how to analyze the language, you can decipher the unwritten truths that will never appear on a balance sheet. The perfect case study for this is to compare the shareholder letters of two corporate giants during their heyday, Jack Welch of General Electric and Warren Buffett of Berkshire Hathaway. Jack Welch was one of the most celebrated CEOs of the 20th century. He was lauded for his tough management style and for GE's remarkably consistent earnings growth during his tenure. His annual letters were reflections of this persona. They were often slick, polished, and filled with corporate jargon. They celebrated GE's successes, often using complex, non-standard accounting metrics to paint the rosiest possible picture. Welch would talk about managed earnings, a concept that implied GE could hit its quarterly profit targets with the precision of a Swiss watch. The tone was one of supreme confidence, of a well-oiled machine that could do no wrong. Reading a GE annual letter from the late 1990s was an exercise in deciphering MBA speak. It was filled with references to synergies, globalization initiatives, and Six Sigma quality. It was impressive, but it was also opaque. It was difficult for an outside observer to truly understand how the company was making its money. The complexity served as a kind of shield, projecting an aura of managerial genius while obscuring the underlying realities of the business. Now contrast this with a Berkshire Hathaway annual letter from the same period. Reading Buffett's writing is like sitting down with a wise, honest, and incredibly clear-thinking uncle. The language is simple, direct, and completely free of jargon. He writes as if he is talking to a business partner, which is exactly how he views his shareholders. The most striking difference is Buffett's obsession with admitting mistakes. In almost every letter, he will dedicate significant space to discussing a business decision that went wrong. He will explain his flawed reasoning, quantify the financial damage, and take personal responsibility. This is an act of incredible intellectual honesty, something almost never found in the polished, self-congratulatory world of corporate communications. Furthermore, Buffett is obsessive about using clear, honest accounting. He scorns the use of adjusted earnings and other financial shenanigans, often including a lesson in his letters on how to spot and interpret these tricks. He wants his shareholders to understand the true economic reality of their business, not a sanitized version. While Welch's letters projected an image of flawless perfection, Buffett's letters projected an image of humble, rational, and continuous learning. History, of course, has provided the final verdict. After Welch retired, the complex and opaque financial structures at GE began to unravel. The managed earnings were revealed to be the product of aggressive, and in some cases questionable, accounting. The company, once the most valuable in the world, entered a long and painful decline. Berkshire Hathaway, on the other hand, continued its relentless march of value creation. Buffett's honesty and clarity were not just a matter of style. They were a reflection of a business that was built on a foundation of reality, not perception. The lesson for any investor or entrepreneur is profound. The way a leader communicates is the way they think. A leader who hides behind jargon and complexity is likely running a business that is itself overly complex and hiding problems. A leader who strives for simplicity, clarity, and honesty is likely running a business with the same attributes. The annual letter is your yearly psychological evaluation of the CEO. Learn to read between the lines, and you will discover more about the company's future than any spreadsheet could ever tell you. The reason that clarity and honesty in communication are such powerful indicators of a leader's quality is rooted in a well-documented psychological principle, the Dunning-Kruger effect, combined with the strategic use of obfuscation. The Dunning-Kruger effect is a cognitive bias whereby people with low ability at a task overestimate their ability. In short, they are too incompetent to recognize their own incompetence. Now, while most CEOs are highly intelligent, a version of this effect can apply to their understanding of their own sprawling businesses. A CEO who doesn't truly, deeply understand the fundamental drivers of every one of their company's divisions will often hide this lack of understanding behind a wall of complexity. They use jargon, buzzwords, and convoluted strategic language as a form of intellectual camouflage. They cannot explain the business in simple terms because they themselves do not understand it in simple terms. Their complex language is a defense mechanism designed to project an image of intelligence and control that masks an underlying confusion. When you hear a CEO talk endlessly about leveraging our core competencies to optimize synergistic platforms in a dynamic, forward-looking paradigm, what you are likely hearing is the sound of someone who doesn't have a clear, simple plan. This is where strategic obfuscation comes into play. Leaders who are insecure about their company's performance or are actively trying to hide problems will deliberately use confusing language and accounting. Complexity is the friend of the charlatan. If they can make the financial statements so convoluted that no one can truly understand them, they can avoid tough questions. If they can fill their shareholder letter with so much jargon that it becomes unreadable, they can deflect scrutiny. This is why the invention of non-standard adjusted earnings metrics is so pernicious. A company might report a loss according to generally accepted accounting principles, GAAP, the standard rules of the road. But in their press release, they will highlight their adjusted EBITDA, a custom-made metric that conveniently excludes real costs like stock-based compensation or restructuring charges, magically turning the loss into a profit. They are creating a fictional narrative and using complexity to sell it. Conversely, a truly brilliant and confident leader has no need for such games. Think of Albert Einstein's famous quote, "If you can't explain it simply, you don't understand it well enough." A CEO who has mastered their business, who understands its economics from the ground up, can and will explain it in simple, clear terms. Warren Buffett's ability to explain complex insurance concepts like float in a way that anyone can understand is a testament to his profound grasp of the subject. His choice to use simple language is a sign of supreme confidence. He has nothing to hide. In fact, he wants his partners, the shareholders, to understand the business as well as he does. This creates a bond of trust and long-term alignment. Clarity, therefore, is not a soft skill. It is a powerful indicator of competence and integrity. A leader who communicates with simplicity and directness is telling you that they are confident in their knowledge and transparent in their actions. A leader who communicates with jargon and complexity is sending up a massive red flag that they are either incompetent, insecure, or dishonest. And as an investor or entrepreneur, you must learn to tell the difference. To arm yourself against this kind of linguistic deception, you need a systematic tool for dissecting a CEO's public statements. Let's call it the shareholder letter litmus test. It's a simple checklist of 5 questions you can apply to any annual report or official communication to gauge the character and competence of the management. The first is the clarity score. Read a page of the letter. Is it written in plain, simple English that a high school senior could understand? Or is it a dense thicket of corporate speak? Count the number of buzzwords: synergy, leverage, platform, optimize, paradigm. The higher the jargon count, the lower the clarity score, and the more skeptical you should be. A CEO who respects their shareholders speaks to them in plain language. A CEO who wants to impress or confuse them uses jargon. The second, and perhaps most important test, is mistake admission. Scour the entire letter for a frank and specific discussion of a mistake made by management in the past year. Does the CEO openly admit to a bad business decision, an operational fumble, or a flawed capital allocation choice? Or is every single sentence about success, progress, and victory? A letter with no admission of error is a work of fiction. Business is hard. Mistakes are inevitable. A leader who refuses to acknowledge them is either dishonest or delusional. A leader who openly discusses them, analyzes them, and explains the lessons learned is a leader you can trust. This is the single greatest hallmark of the Buffett approach. The third question on our checklist is about performance metrics. Look at how the company discusses its financial results. Are they using the standard audited GAAP numbers as the headline figures? Or are they immediately pushing you to look at their own custom-made, non-GAAP metrics like adjusted net income or community-adjusted EBITDA? A heavy reliance on non-GAAP numbers is a giant red flag. It's a management team telling you, we don't want you to look at the real results. We want you to look at this more flattering version we invented. Honest managers report the real numbers first. Fourth is the test for owner orientation. What is the tone of the letter? Does the CEO refer to shareholders as partners or fellow owners? Does the writing reflect a mindset that they are managing your money? Or does it have an impersonal, corporate tone, referring to the company as an abstract entity and treating shareholders as a faceless external group? Buffett famously begins his letters to the shareholders of Berkshire Hathaway, and his writing is saturated with the language of partnership. This isn't just a stylistic choice. It's a reflection of a deep-seated belief that he works for the owners. Finally, there is the candor about the future test. How does the CEO describe the company's prospects and challenges? Is it all boundless optimism and promises of a glorious future? Or is there a sober, realistic assessment of the competitive landscape, potential risks, and the challenges the business faces? A leader who only sells you the sunshine is a promoter, not a manager. A true business leader understands the terrain, respects their competitors, and is honest with their partners about the hills they have to climb. By running every annual letter through this 5-part litmus test, you can move beyond the numbers and perform a powerful psychological and ethical audit of the company's leadership. The antithesis of the clear-thinking, honest CEO is a specific and dangerous archetype, the promotional CEO. This is the leader who is not a business operator at heart, but a stock promoter. Their primary skill is not manufacturing a product or managing a supply chain. It is manufacturing a narrative. Their goal is not to create long-term intrinsic value, but to create short-term stock market hype. Their annual letters and public appearances are not reports on the state of the business. They are performances designed to sell a story. This type of leader is particularly common in hot industries, where the stories are easier to sell. In the dot-com era, it was internet visionaries. In the 2020s, it might be CEOs of electric vehicle startups, biotech companies with a miracle drug, or companies involved in cryptocurrency or artificial intelligence. The specific industry doesn't matter. The pattern of behavior is always the same. The promotional CEO's communication is defined by hyperbole. Everything is revolutionary, game-changing, or disruptive. They speak in grand, sweeping visions of the future, promising to change the world. They compare their company to Apple, Google, or Tesla, even if they have little to no revenue. This language is designed to trigger the investor's fear of missing out. The focus is always on the distant future because the present reality is often bleak. The company may be burning through cash and have no clear path to profitability. But the promotional CEO will distract from this by painting a dazzling picture of a trillion-dollar market they are about to conquer. They will emphasize vanity metrics over real financial performance. Instead of talking about profits or cash flow, they will talk about website traffic, social media followers, or the number of pre-orders for a product that doesn't exist yet. These are metrics designed to create the illusion of progress without the substance of actual business success. The annual letters from these CEOs fail every part of our litmus test. They are devoid of mistake admission because in the story they are selling, there are no setbacks, only a relentless march towards destiny. They are filled with custom-made, non-GAAP metrics designed to obscure massive losses, and their tone is not that of a partner, but of a prophet, speaking down to the masses. They are not managing a business. They are leading a movement. The SPAC, Special Purpose Acquisition Company, boom of 2020 and 2021, was a breeding ground for this type of leader. Companies with little more than a PowerPoint presentation were able to go public and achieve multi-billion-dollar valuations by selling a futuristic story to an eager market. Many of these companies have since seen their stock prices collapse by 90% or more as the reality of their business performance failed to live up to the hype. Learning to identify the promotional CEO is a critical survival skill in modern investing. You must learn to separate a compelling story from a compelling business. A great business is run by a sober realist who is focused on the day-to-day execution of a clear plan. A hype-driven stock is run by a charismatic storyteller who is focused on selling you a dream. The former can make you rich over the long term. The latter will almost certainly leave you with nothing but a good story to tell about how you lost your money. The deception of the promotional CEO and the obfuscation of the insecure manager have a direct, tangible impact on the financial statements. This is where we can find the smoking gun. The direct financial connection is the gap between GAAP earnings and non-GAAP earnings. Understanding this distinction is the key to unlocking the truth behind the numbers. GAAP, or Generally Accepted Accounting Principles, is the official rulebook for corporate accounting in the United States. It's designed to ensure that financial statements are consistent, comparable, and transparent. When a company reports its net income according to GAAP, it is reporting a number that has been calculated according to these strict, standardized rules. However, in recent decades, it has become increasingly popular for companies to also report a second, unofficial set of earnings. They call them non-GAAP earnings, pro forma earnings, or adjusted earnings. These are numbers that management has invented. They take the official GAAP number and start making adjustments. They say, well, the GAAP number includes this one-time expense that we don't think you should worry about, so we're going to add that back. Or, it includes the cost of paying our employees with stock options, but that's not a real cash cost, so we're going to ignore that too. The problem is that these adjustments almost always make the company's performance look better than it actually is. By far the most common and egregious of these adjustments is the exclusion of stock-based compensation. When a company pays its employees, especially its executives, with stock options, it is a very real expense. The company is giving away a piece of itself, which dilutes the ownership of the existing shareholders. It is a transfer of value from the owners to the employees. GAAP rules correctly require that this be treated as an expense on the income statement. But in the world of non-GAAP, this real cost magically disappears. A company can report a GAAP loss of $100 million, but then tell you that $150 million of its expenses were for stock-based compensation. By simply adjusting for this, they can claim a non-GAAP profit of $50 million. It's financial alchemy. A management team that consistently and aggressively promotes its non-GAAP earnings over its GAAP earnings is sending a clear, unambiguous signal. They are telling you that they do not believe the official audited reality of their business is good enough. They feel the need to create a more flattering, fictional version of their performance. This is the ultimate red flag for any serious business analysis. When you are looking at a company's earnings report, your first step should always be to find the GAAP net income. That is the truth. Then, compare it to the adjusted number that the company is trumpeting in its headline. Is the gap between the two large and growing over time? Why? Read the footnotes to see exactly what adjustments they are making. Are they excluding costs that seem like real recurring business expenses? If so, you are likely looking at a management team that is prioritizing perception over reality. And in the long run, reality always wins. The gap between GAAP and non-GAAP is not just an accounting detail. It is a measure of management's integrity. We now reach a crucial turning point in our analysis, the fourth pillar of Buffett's philosophy. We have established how to spot the psychological pitfalls of the institutional imperative, how to judge a CEO's skill at capital allocation, and how to read their character in their communications. But all of this analysis is meaningless if it is applied to the wrong subject. Buffett has a famous and slightly bleak saying that has saved him from countless investment disasters. When a management with a reputation for brilliance tackles a business with a reputation for bad economics, it is the reputation of the business that remains intact. This is the principle of the primacy of the business itself. It's the recognition that even the greatest CEO in the world, a Tom Murphy or a Warren Buffett, is helpless to create long-term value if they are at the helm of a fundamentally flawed enterprise. The most painful and personal lesson Buffett ever learned on this front came from his own history, with the company that gave Berkshire Hathaway its name, the original textile mills. In the early 1960s, a young Warren Buffett began buying stock in a struggling New England textile manufacturer called Berkshire Hathaway. He saw it as a classic cigar butt investment, a terrible business available at a dirt-cheap price. He figured there was one last puff of profit left in it. Through a series of events, he ended up with a controlling interest in the company. He was now the chairman of a business in an industry with horrific economics. The American textile industry was facing a brutal onslaught of foreign competition with much lower labor costs. It was a commodity business, meaning there was no way to differentiate its product. Cloth was cloth. This led to vicious price competition and razor-thin profit margins. It was a sinking ship. But Buffett, filled with the confidence of youth, believed he could turn it around. He hired a talented manager named Ken Chase to run the operations. They poured money into new, more efficient equipment. They worked tirelessly to cut costs and improve the business. For 20 years, from 1965 to 1985, Buffett and Chase fought this battle. They were brilliant managers, applying all of their energy and intelligence to the problem. But it was a hopeless cause. For every dollar of new capital they invested in the textile business, they got a pitiful return. The fundamental economics of the industry were like a powerful headwind that no amount of managerial skill could overcome. They were running as fast as they could just to stay in the same place. Buffett would later describe this experience using a powerful analogy. He said that being the manager of a business like that was like being in a rowboat with a leak. You could spend all your time and energy bailing water out, and you might even feel like you're making progress. But you'd be far better off just getting into a sturdy ship in the first place. Finally, in 1985, Buffett made the difficult but rational decision to give up. He closed the last textile mill. The 2 decades spent trying to save the business had produced nothing but mediocre returns and immense frustration. He considered the capital he had tied up in the textile operations for all those years to be a massive opportunity cost. That money, if it had been invested in a good business from the start, would have compounded into a far greater sum. This experience seared a lesson into his brain that would become a core tenet of his investment philosophy. The quality of the business comes first. Your job as an investor or entrepreneur is not to find a brilliant manager to fix a broken business. Your job is to find a business so wonderful that a merely competent manager can produce excellent results. The horse is more important than the jockey. A brilliant jockey on a sick horse will not win the race. The psychological trap that ensnares even brilliant managers in terrible businesses is a potent combination of optimism bias and overconfidence bias. These are two of the most pervasive and powerful cognitive biases, and while they are often essential for success in life and business, they can become a fatal flaw when misapplied. Optimism bias is our natural human tendency to believe that we are less likely to experience a negative event than others. It's the "it won't happen to me" feeling. For a CEO, this is often a prerequisite for the job. You have to be an optimist to lead a large organization, to inspire your employees, and to invest for the future. You have to believe that your company will succeed where others have failed. Overconfidence bias is its close cousin. This is our tendency to have excessive confidence in our own answers, skills, and judgments. We systematically overestimate our own abilities. A successful CEO, by definition, has a track record of being right. This success reinforces their self-belief, sometimes to a dangerous degree. Now, imagine a brilliant, optimistic, and highly confident CEO looking at a company in a terrible industry. Let's say an airline. Airlines are a notoriously bad business. They have high fixed costs, brutal competition, powerful unions, and are subject to the whims of fuel prices and the economy. The history of the airline industry is a graveyard of bankruptcies, but our brilliant CEO looks at this landscape and thinks, yes, it's a tough business, but all those other companies failed because they had bad management. I'm different. I'm smarter. I'm a better operator. I can succeed where everyone else has failed. This is the optimism and overconfidence bias in action. They believe their personal skill is enough to overcome the industry's structural, economic awfulness. They believe this time is different because they are involved. This is precisely the trap Warren Buffett fell into with the Berkshire textile mills. He was young, brilliant, and confident in his ability to outsmart the market. He believed his managerial acumen could turn a bad business into a good one. He learned painfully that the fundamental economics of the business were a far more powerful force than his own intellect. This is why Buffett often says he looks for businesses that an idiot could run. It's a bit of an exaggeration, but his point is profound. He wants a business whose competitive advantage is so strong, whose moat is so wide, that it can survive even mediocre management. Companies like Coca-Cola or See's Candies have such powerful brands and simple operations that they are almost guaranteed to be profitable for decades to come, regardless of who is at the helm. A great CEO can certainly enhance their results, but a bad one is unlikely to destroy them. The psychological discipline required here is a form of humility. It's the ability for a leader to honestly assess a situation and recognize when a problem is not solvable through sheer effort or intelligence. It's the wisdom to know which battles to fight and, more importantly, which ones to avoid entirely. A CEO who lacks this humility, who is blinded by their own optimism and overconfidence, will inevitably lead their shareholders into a quagmire from which there is no escape. To avoid this brilliant manager bad business trap, you must develop a disciplined mental model for evaluating the business first before you ever consider the quality of its leadership. Let's call it the business first evaluation framework. This is a step-by-step process to ensure you are analyzing the horse before you analyze the jockey. Step 1 is to forget the specific company and analyze the industry. Is this a good neighborhood to be in? Is the industry growing, or is it in a state of terminal decline? Think about newspapers, for example. The internet has structurally destroyed their business model. Even the most brilliant newspaper editor in the world cannot reverse that tide. Look for industries with tailwinds, secular trends that will lift all the boats. Avoid industries with headwinds that will make success nearly impossible. Step 2 is to apply a simplified version of Michael Porter's 5 forces analysis. You don't need a business degree to do this. Just think through these 5 questions about the industry. 1. How intense is the competition? Is it a brutal dogfight with dozens of rivals cutting prices? Or is it a comfortable oligopoly with a few rational players? 2. How easy is it for new competitors to enter? Is there a high barrier to entry, like a strong brand or massive capital requirements? Or can anyone start a competing business in their garage? 3. How much power do the customers have? Can they easily switch to a competitor for a lower price, or are they locked in? 4. How much power do the suppliers have? Can the suppliers dictate prices to the company, or does the company have many options? 5. Is there a threat of a substitute product coming along and making the whole industry obsolete? Answering these 5 questions will give you a robust picture of the economic quality of the industry. Step 3 is the durability test. This is a simple but powerful thought experiment. Ask yourself, is it highly likely that this business will be significantly larger and more profitable 10 years from now? This forces you to think about the long-term competitive advantage, or moat, of the business. What protects it from competition? Is it a beloved brand like Apple? A low-cost process like Geico? A network effect like Facebook? If you cannot clearly articulate the moat and why it will last for a decade, you should probably move on. Only after a business has passed these first 3 tests, it's in a good industry, it has favorable competitive dynamics, and it has a durable moat, do you proceed to step 4, analyzing the CEO. Now you can apply all the tools we've already discussed, judging their capital allocation, reading their letters, looking for an owner's mindset. The key is the sequence. By analyzing the business first, you protect yourself from being seduced by a charismatic, brilliant leader who is fighting a losing battle. This framework ensures you are looking for the winning combination that Buffett always seeks, a great business run by a great manager. Finding just one of these is not enough. You need both, but you must always start by finding the great business. The most seductive and dangerous trap for the 99% of investors is the turnaround story. It's a narrative that appeals to our love of an underdog and our desire for a quick, dramatic win. The story is always the same. A once great company has fallen on hard times. It's in a tough industry, its profits have vanished, and its stock price has been crushed. But then, a savior arrives. A new, charismatic, hotshot CEO is hired, often from a more successful company. They make bold promises on financial television. They announce a dramatic new strategy. They talk about unlocking hidden value and restoring the company to its former glory. The media loves the story. Analysts upgrade the stock, and for a while the stock price soars on the hope and the hype. Investors who get in on the ground floor feel like geniuses. They are part of the great turnaround. But more often than not, the story ends in tears. The new CEO, for all their brilliance and energy, quickly discovers that the company's problems are not so easily solved. The turnaround they promised runs headfirst into the brutal reality of the business's terrible economics. If it's a struggling retailer, they discover that they still can't compete with Amazon's prices and convenience. If it's an airline, they discover that they still can't control the price of jet fuel or the cyclical nature of travel. The fundamental problems that caused the company to decline in the first place have not changed. The initial burst of enthusiasm fades. A few quarters of poor results come in. The hotshot CEO, who was once hailed as a savior, starts to sound defensive. The stock price begins its long, painful slide back to where it started, and often much lower. Warren Buffett is famously averse to these situations. He has a simple saying, "Turnarounds seldom turn." He learned from his own experience with the textile mills that trying to fix a fundamentally broken business is a low-probability bet. The odds are stacked against you. He would much rather pay a fair price for a wonderful business than a cheap price for a terrible one. The psychological appeal of the turnaround is that it feels like a bargain. You're buying a famous name at a fraction of its former price. It taps into our desire to be the clever investor who saw the value that no one else did. But what most investors fail to realize is that a business with a long history of poor performance is usually cheap for a very good reason. It has no sustainable competitive advantage. It is a sick horse. And as we know, putting a great jockey on a sick horse does not win you the race. The path of the 99% is to be drawn in by the exciting narrative of the turnaround. The path of the professional is to follow Buffett's advice and stay away. Look for the simple, boring, wonderful businesses that don't need to be turned around. They just need to be left alone to continue their steady, relentless compounding of value. That is where true long-term wealth is built. The irrefutable evidence of a business's quality, the financial fingerprint that separates a great enterprise from a terrible one, can be found on the income statement. It lies in two simple but powerful numbers: gross margins and operating margins. These numbers are the direct financial connection that reveals the underlying economic reality of a business, a reality that no CEO, no matter how brilliant, can fundamentally alter. Gross margin is calculated by taking a company's revenue and subtracting the cost of goods sold, the direct costs of producing whatever it sells. It tells you how much profit the company makes on each individual sale, before accounting for overhead costs like marketing, salaries, and research. A business in a highly competitive commodity industry will have very low gross margins. A wheat farmer, for example, has almost no control over the price of wheat. They are a price taker. Their gross margins will be thin and volatile. A company like Coca-Cola, on the other hand, sells a product that costs very little to make, but because of its powerful brand, it can charge a significant premium. Its gross margins are consistently and enviably high. Operating margin takes the analysis a step further. It's calculated by taking the gross profit and then subtracting all the other operating expenses required to run the business. This number tells you how profitable the core business is. A high operating margin is the sign of a truly wonderful business. It means the company not only has strong pricing power, high gross margins, but it is also run efficiently, without a bloated cost structure. When you are analyzing a business, the first thing you should do is look at a 10-year history of its gross and operating margins. For a great business, you will see two things. The margins will be consistently high, and they will be stable or even increasing over time. This is the financial evidence of a durable competitive moat. The company is able to fend off competitors and protect its profitability year after year. Now, consider a bad business. Its 10-year margin history will tell a very different story. The margins will likely be low, and more importantly, they will be volatile and unpredictable. In good years, they might be okay, but in bad years, they might disappear or even go negative. This is the sign of a business with no moat, one that is constantly at the mercy of its competitors, its customers, and the broader economy. No matter how brilliant a CEO is, they cannot magically create high margins in a commodity business. They can cut costs at the edges, they can try to be more efficient, but they cannot fundamentally change the fact that their customers have many other choices and will not pay a premium for their product. This is why Buffett's lesson from the textile mills was so profound. He and Ken Chase were brilliant operators. They likely ran the mills more efficiently than any of their competitors. But even with their best efforts, the margins were always terrible, because the industry's economics were terrible. The numbers on the income statement told the true story. Looking at a company's margin history is the ultimate antidote to the seductive narrative of a turnaround. A CEO can promise to fix a business, but if the margins have been consistently poor for a decade, the odds are overwhelmingly against them. The numbers don't lie. They reveal the fundamental character of the business, a character that even the most talented leader is powerless to change. This brings us to our fifth and final pillar, the ultimate synthesis of Buffett's philosophy on leadership. It is the crucial distinction between a CEO who operates with an owner's mindset versus one who is merely playing the manager's game. This is not about skill or intelligence. It is about perspective and incentives. The CEO with an owner's mindset views the company's capital as their own. The CEO playing the manager's game views it as a resource to be used to advance their own career, prestige, and compensation. Understanding which type of person is running the company you've invested in is the final and most important piece of the puzzle. And for Buffett, the perfect embodiment of the owner's mindset was a tiny, indomitable Russian immigrant who built a retail empire in Omaha, Nebraska, on a foundation of brutal honesty and relentless hard work. Her name was Rose Blumkin, but everyone knew her as Mrs. B. The story of Mrs. B and the Nebraska Furniture Mart is pure entrepreneurial legend. She fled Russia in 1917, arrived in America unable to speak a word of English, and in 1937, with a $500 loan, she started a small furniture store in the basement of her husband's shop. Her business philosophy was radical in its simplicity: sell cheap and tell the truth. She operated with virtually no overhead, bought in bulk directly from manufacturers to get the best prices, and passed those savings on to her customers. She was a fanatical cost cutter and a workaholic, famously working 7 days a week well into her 90s. She treated her customers like family and her employees with tough, demanding love. She built the Nebraska Furniture Mart into the single largest home furnishing store in the United States, a behemoth that dominated the Midwest market, all through word of mouth and a relentless focus on her simple motto. In 1983, Warren Buffett decided he wanted to buy the company. He went to meet the then 89-year-old Mrs. B. He asked her how much she wanted for the business. She gave him a number. He looked at her and said, "We'll take it." The deal was sealed with a simple handshake. There was no army of investment bankers, no teams of lawyers conducting months of due diligence. Buffett famously did not even have the company's books audited. As he explained later, "I'd rather have a handshake with Mrs. B than a 300-page contract with some other people." Why? Because he knew he was dealing with an owner, not a manager. He knew her numbers would be honest, because her entire life was a testament to her integrity. He was buying not just a business, but the character of its founder. After selling 90% of the business to Berkshire Hathaway, Mrs. B continued to run it with the exact same frugal, customer-obsessed passion as before. She was now managing a business for Buffett, but in her mind, nothing had changed. It was still her store, her customers, her money. She couldn't conceive of operating any other way. That is the owner's mindset. It's an indivisible fusion of personal identity and corporate duty. It's a deep, instinctual understanding that every dollar of the company's money is a sacred trust, to be guarded and grown as if it were your own life savings. The fundamental conflict that arises when a company is not run by a founder like Mrs. B is explained by a core economic theory known as the principal-agent problem. This is the final psychological principle we must understand to complete our framework. The principal is the owner of the business, the shareholders. The agent is the person hired to run the business on their behalf, the CEO. In a perfect world, the agent would always act in the absolute best interest of the principal. But in the real world, their incentives are often misaligned. The principal wants one thing: the long-term increase in the intrinsic value of their shares. The agent, the CEO, may want many other things. They might want a bigger salary, a larger bonus, a corporate jet, a fancy headquarters, more power, and more prestige. The actions that lead to these things for the agent do not always lead to better returns for the principal. For example, a CEO whose bonus is tied to revenue growth has a powerful incentive to grow revenues at any cost, even if it means making unprofitable acquisitions or chasing low-margin business. This grows the empire and the CEO's paycheck, but it can destroy shareholder value. This is the manager's game. The CEO is not thinking like an owner. They are thinking like an employee who wants to maximize their own personal gain within the rules of the system. Corporate boards have tried to solve this problem for decades, most famously by paying CEOs with stock options. The theory was that if the CEO owns stock, they would start to think like a shareholder. But this has often backfired. Stock options can encourage short-term thinking. A CEO might take reckless risks or slash long-term investment in things like research and development, all to goose the stock price in the short term so they can cash out their options. They might also lobby the board to set the strike price of their options artificially low or to reprice them after the stock has fallen, ensuring they get a big payout even if long-term shareholders have suffered. The principal-agent problem explains why bureaucracy bloats, why value-destructive mergers happen, and why executive compensation can spiral to levels that seem completely disconnected from performance. It is the natural consequence of separating ownership from control. The rare CEO who can overcome this, who can genuinely adopt the mindset of the principles they serve, is the CEO you want to partner with. They are not playing a game against the shareholders. They see themselves as being on the same team. They feel the pain of losses as if they were their own, and they take pride in creating lasting value, not just in collecting a paycheck. Identifying this mindset is the ultimate goal of Buffett's qualitative analysis. It's the search for the next Mrs. B, the leader for whom there is no difference between the company's money and their own. So how do we as outside investors systematically identify a CEO with this rare and precious owner's mindset? We can create a final mental model, the skin in the game scorecard. It's a 4-part test to measure the alignment between management and shareholders. The first and most important factor is insider ownership. What percentage of the company's stock does the CEO and the management team personally own? And crucially, how did they acquire it? Was it granted to them as part of their compensation package, or did they go into the open market and buy it with their own hard-earned money? A CEO who owns a significant chunk of their company, purchased with their own cash, is a CEO whose interests are powerfully aligned with yours. They will feel the pain of a falling stock price in their own net worth. A CEO with minimal ownership is just a hired hand. They have far less to lose. The second part of the scorecard is an analysis of the compensation structure. This requires digging into the company's annual proxy statement, where the details of executive pay are disclosed. Don't just look at the total number. Look at what drives the bonus. Is it tied to intelligent, value-creating metrics, like growth in intrinsic value per share or return on invested capital? Or is it tied to vanity metrics like revenue size, empire building, or simply hitting a Wall Street earnings per share target? The former rewards owner-like behavior. The latter rewards playing the manager's game. The third test is the frugality test. Look for signs of a cost-conscious corporate culture. Does the annual report brag about a lavish, multi-billion-dollar new headquarters, a corporate campus designed by a celebrity architect? Or is the company run out of a modest, functional office? Read the proxy statement for details on perks. Does the CEO have access to a fleet of corporate jets, a company-owned apartment, and an army of personal assistants? Or do they, like Tom Murphy at Capital Cities, operate with a lean, frugal ethos? Frugality is a powerful indicator of an owner's mindset. An owner is careful with their own money. A manager is often happy to spend someone else's. Finally, we return to communication style. Does the CEO talk like your partner in a business venture? Do they communicate with the clarity, honesty, and humility we've discussed? Or do they sound like a professional manager, a hired gun, who speaks in the detached, impersonal language of corporate bureaucracy? The language they use reveals their underlying perspective. By systematically scoring a CEO on these 4 criteria: high insider ownership bought with their own money, a rational compensation structure tied to long-term value, a culture of frugality, and a communication style of a partner, you can arrive at a highly accurate assessment of whether you are dealing with a true owner or just another player in the manager's game. The antithesis of the owner-minded leader like Mrs. B is the ultimate villain in our story, the empire builder. This is the CEO who is pathologically obsessed with the size of the company they run. Their primary motivation is not to create the most profitable or efficient company, but simply the biggest. They are the living embodiment of the principal-agent problem. A leader who single-mindedly pursues a strategy that benefits their own ego, power, and prestige, often at the direct and catastrophic expense of their shareholders. The empire builder's favorite tool is the large, flashy, transformational merger. They are constantly on the hunt for a deal that will put them on the cover of Forbes and make their company a household name. The strategic logic of these deals is often flimsy, papered over with buzzwords like synergy and growth platforms. The real logic is far simpler. A bigger company means a bigger CEO. The CEO of a $50 billion company is paid more, is more famous, and has more power than the CEO of a $20 billion company. There is no more infamous or destructive example of this phenomenon than the merger of America Online, AOL, and Time Warner in the year 2000. At the peak of the dot-com bubble, AOL, the king of the new media, acquired Time Warner, the titan of old media. It was hailed as a visionary deal that would define the future of the internet and entertainment. The deal was driven by the egos of the leaders involved, who were desperate to create the largest and most powerful media company on the planet. But the business logic was a fantasy. The promised synergies never materialized. The cultures of the two companies clashed horribly. And most importantly, the architects of the deal had made the classic mistake of overpaying at the absolute peak of a market bubble. The aftermath was a financial cataclysm. Just 2 years after the merger, the company was forced to take a goodwill impairment charge of nearly $100 billion, at the time the largest annual corporate loss in U.S. history. It was a public admission that the value of the deal had been almost completely vaporized. The stock price collapsed, wiping out hundreds of billions of dollars of shareholder wealth. The AOL-Time Warner merger stands as a permanent monument to the dangers of empire building. It's what happens when a CEO's ego, fueled by the irrational exuberance of a bull market, becomes unmoored from the fundamental principles of business valuation and rational capital allocation. It is the ultimate expression of the manager's game, played for the highest possible stakes, with the shareholders' money. The final and most personal way the manager's game harms you as a shareholder is through the slow, insidious bleeding of your ownership stake. The direct financial connection here is stock-based compensation and the resulting share dilution. This is where the misalignment of incentives hits your personal bottom line. As we've discussed, companies, especially in the tech sector, often pay their employees and executives with large grants of stock or stock options. Management will tell you that this isn't a real cash expense. But this is a dangerous half-truth. While it doesn't require the company to write a check, it is a very real cost to the owners. Every time a company issues a new share of stock to an employee, your existing shares become a slightly smaller slice of the overall corporate pie. Your ownership is being diluted. Imagine you own 100 shares of a company that has 1,000 shares outstanding. You own 10% of the company. Now the company's board decides to grant the CEO 100 new shares as a bonus. There are now 100 shares outstanding. Your 100 shares now only represent about 9% of the company. A portion of your ownership has been transferred to the CEO without you ever selling a single share. A reasonable amount of stock-based compensation can be a good thing, helping to attract and retain talent. But in many companies, it has become a way for management to pay itself lavishly at the direct expense of the owners. A CEO playing the manager's game will use stock compensation aggressively. It allows them to report higher adjusted non-GAAP profits by excluding the cost, while still rewarding themselves and their employees handsomely. An owner-minded CEO, in contrast, is allergic to dilution. They view the company's stock as a precious, almost sacred thing. They would never dream of issuing it carelessly, because doing so would be diluting their own ownership stake and that of their partners. Buffett, for example, is famously stingy with issuing Berkshire stock. He understands that it is the most expensive currency he has. As an investor, you must become a dilution detective. You can find the information you need in the company's financial statements. Look at the cash flow statement for a line item called stock-based compensation. See how large that number is relative to the company's net income. Then, look at the company's historical share count. You can find this in the annual report. Has the number of shares outstanding been steadily increasing over the last 5 or 10 years, even when the company hasn't made a major acquisition? If so, you are being diluted. Your ownership stake is being eroded year after year. A rising share count is one of the clearest signs that management is playing the manager's game, quietly paying itself by taking a slice of your pie. It is the silent killer of shareholder returns. You have just journeyed deep into the mind of the world's greatest investor. You have moved beyond the sterile world of spreadsheets and financial ratios. You no longer see a company as just a collection of numbers. You now possess the framework to look through the financials and analyze the single most critical component of any business: the character, the rationality, and the incentives of the person in the pilot's seat. You understand the invisible force of the institutional imperative. You can judge the critical decisions of capital allocation. You can read the hidden language of an annual letter. You know why a great business is paramount, and you can distinguish a true owner from a mere manager. This is a powerful mental tool you have just acquired. But judging a leader is only one piece of a much larger mosaic. This entire framework for analyzing the CEO is built on a crucial foundation that we've only touched upon. Understanding the person is useless if you don't understand the fundamental economic fortress they command, or the crumbling shack they're trying to defend. The greatest CEO in the world is helpless without a durable competitive advantage, what Buffett calls a moat. The analysis of the jockey is only powerful when combined with an equally deep analysis of the horse. The video that is now on your screen is the missing link. It is the next piece of the map. It moves beyond the leader and gives you the tools to analyze the business itself. It explains in granular detail how to identify these economic moats, the deep, structural advantages that allow companies to fend off competitors and earn outsized profits for decades. It will teach you to see the invisible walls that protect a great company. It connects the who of leadership with the what of the business, forging the two halves of the analysis into a single, unbreakable chain of investment logic. Many will stop here, content with this single piece of the puzzle. But for those of you who are serious about wealth management, for the entrepreneurs and executives committed to building something that lasts, the journey continues. Completing your mental arsenal requires understanding both the jockey and the horse. The choice to click is a choice to graduate from simply analyzing people to mastering the analysis of power. Continue your ascent,